All right, today we're going to deconstruct a really fascinating puzzle. We're diving into a quantitative report on Kratos Defense and Security, a company that's right at the cutting edge of military tech. Now, the report's final conclusion is, well, it's pretty brutal, but the story behind it is way more complex. So, let's break it all down. So, right out of the gate, the report hits you with its final verdict. And wow, they do not mince words. That is a seriously stark conclusion for a company in what's supposed to be a massive growth industry. Our job here is to figure out how they got there, to trace the analysis backward and see what data led them to such a clear warning.
And the official number behind that warning? Just 2 stars. Now, in Morningstar's system, that basically labels the stock a somewhat unattractive choice. And right away, you've got this head-scratcher. A company making these futuristic, high-tech drones and defense systems is getting a clear stay-away signal from the financial models. We need to find out why.
So here's our game plan for unpacking this whole thing. First, we'll get a handle on the business itself, the drones and the dollars. Then we're going to dive deep into the numbers that are flashing red, building the case against the stock. After that, we'll switch gears and uncover the hidden strengths that give it a fighting chance, what the report calls its moat. And finally, we'll pull it all together to really understand the dilemma any investor would face looking at this. Okay, let's kick things off with section 1. Because, look, none of the financial metrics are going to make a lick of sense until we understand the underlying business. So what exactly does Kratos Defense and Security do? In simple terms, Kratos is all about creating the next generation of military technology. They really lean into making these advanced systems, things like drones, communication platforms, not just groundbreaking in what they can do, but also affordable to build. And that really positions them as a key player in this whole new world of national security. Okay, so where's the money coming from? It's split into 2 main buckets. The big one, we're talking 70% of their revenue, comes from Kratos Government Solutions. This is kind of the foundational stuff: satellite communications, cybersecurity, turbine tech. Then you've got the other 30%, which is the Unmanned Systems Division. Now, this is the flashy, high-profile part of the business, with all the cool drones and robots. But it's so important to remember that it's the less glamorous government side that's really paying the bills right now. All right, now that we know what they do, let's get into the messy part, the heart of the report's concerns. This is where we look at the numbers that earn them that 2-star rating. First up, what is the market saying? Well, as of March 20th, 2026, the stock closed at $84.62. That's not just a number. It's what thousands of investors have collectively decided this company is worth. This is our starting line. But now, let's put that up against what the model thinks it should be worth. Morningstar's quantitative fair value estimate comes in at $77.26. And right away, you can see a pretty big gap opening up. And this slide just lays it all out, doesn't it? That market price of over $84 is way above the estimated fair value, about a 20% premium, according to the report. But, and this is a huge but, look at that little note: high uncertainty. That means the model itself is saying, hey, there's a really wide range of possible outcomes here. So it's not just that the stock looks overvalued, it's overvalued with a big, flashing question mark attached. So what's behind all this uncertainty? Well, the report points a finger directly at a lack of profitability. And in any analysis, that's a major red flag. Why? Because profitable companies can weather economic storms much better, and they're the ones most likely to generate real cash for their investors down the road. Without consistent profits, the whole foundation feels a bit wobbly. And wow, this slide just puts the problem in black and white using 2 key numbers. First, look at gross margin. Think of it as how much they make on each sale before overhead. At just under 23%, they rank in the bottom third of companies globally. That screams tough competition and squeezed profits. But then you look at its price tag, the EV to EBITDA ratio. At 135, it's in the top 10% globally. So investors are paying an absolutely massive premium for every dollar the company earns. See the conflict? The company isn't very profitable, but the market is pricing it like it's the next big thing. But wait, the story doesn't end there. If it were just about those numbers, this would be a really short explainer. The thing is, the analysis also finds some serious strengths. So let's pivot and look at the case for Kratos. To get the positive side of the story, you need to understand this one key idea: the economic moat. You've probably heard Warren Buffett talk about this. It's just a metaphor for a company's competitive advantages. The barriers that keep rivals at bay. It's a great visual, right? Imagine the company's profits are a castle. The economic moat is the giant ditch around it that no one can cross. It could be a powerful brand, crucial patents, or just making it really hard for customers to switch.
The wider the moat, the safer the castle.
And this is where the whole story flips on its head. Despite all those red flags we just talked about, the valuation, the weak profits, the very same Morningstar report gives Kratos a narrow moat rating. That is a huge vote of confidence in the company's core business and its place in the defense industry. So what does a narrow moat actually mean in plain English? Well, according to the report's own methodology, it implies some really positive things. First, that Kratos has real, durable, competitive advantages. Second, the model expects the company to make more money than it costs them to operate for at least the next 10 years. And third, its overall financial health is considered pretty decent. This paints a completely different picture from those valuation numbers, doesn't it? And that brings us to our final section, and really the heart of the matter, the investor's dilemma. We have two totally different stories coming from the exact same report. So how do you square that circle? This slide just lays the whole conflict bare. On one side, you have all the red flags. The stock price looks way too high. Profitability is low right now, and there's a ton of uncertainty. But on the other side, you've got some serious muscle. A solid competitive position, that narrow moat, a focus on crucial defense technology, and decent financial health. So here's the takeaway. The analysis sees a good company, but maybe a bad stock, at least at its current price. And really, it all boils down to this one fundamental question that every investor has to ask themselves. On one side of the scale, you have Kratos' future potential, its moat, its technology. On the other side, you have its current reality, a premium price tag and weak profits. So the question this report leaves us with is this: when does the promise of tomorrow justify the price you have to pay today? For Kratos, that question, well, it's everything.